on
Yeah,
silver?
I think it's going well above $120. And again, just like you mentioned, great fan factors on gold, the longer term. Same thing. The applications of silver. Silver again is a major byproduct of iron and lead mining, right? And ultimately, what we're seeing here is that no one's really mining silver per se to mine silver, at least not right now. It's just that byproduct. And I think ultimately that's one of the best bull cases for silver over the long term is that again, that's going to draw out less and less supply with the industrial demand for the industrial complex, essentially missiles, etc. And that's going to drive it much higher down the line. So I would think $200. If gold hits, let's say 7,500, I would think you're at $200 to $250 on silver within 2 to 3 years.
Gold and silver, long viewed as the ultimate refuge in times of financial stress, are entering a phase that could surprise even seasoned investors. Despite geopolitical tensions and rising economic uncertainty, both metals have shown signs of near-term weakness. Market strategists caution that this apparent contradiction may not signal the end of the bull market but rather the final stage of a necessary reset before another powerful advance. According to Gareth Soloway, chief market strategist at Verified Investing, the recent pullback in gold reflects a classic market pattern that often appears after strong rallies fueled by emotional momentum. In previous months, gold surged rapidly toward record levels, attracting waves of new participants eager to capitalize on the trend. However, when markets rise too quickly, speculative enthusiasm can push prices beyond sustainable levels. From a chart-based perspective, the recent structure resembles what traders refer to as a bearish flag formation. This pattern typically develops after a sharp decline followed by sideways consolidation, often signaling that prices may attempt another downward move before stabilizing. Based on this interpretation, Soloway suggests that gold could revisit support zones between roughly $4,400 and $4,300 in the coming months. In a scenario driven by heightened fear and forced liquidation across financial markets, the metal could even temporarily fall toward $3,500 per ounce before regaining its footing. Such a development would not necessarily contradict gold's long-term bullish outlook. During major financial disruptions, investors frequently sell nearly all assets, including traditional safe havens, to meet margin calls and raise liquidity. Historical precedents illustrate this dynamic. In the early stages of the COVID-19 market panic in 2020, gold initially dropped alongside equities before recovering sharply once monetary stimulus and investor confidence returned. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates on gold, silver, and precious metals market.
Yeah, and this is really interesting because, like you mentioned, gold is usually a safe haven asset. In other words, it should have been roaring the last 2 weeks with this conflict with Iran, and instead it's actually been weak. If we turn to the charts here, take a look at this. So I want to draw my attention on the charts to this period going into the final run up on gold. This, just like silver, was where momentum and emotion took over. That's what had to be wiped out right there with the drop back to 4,400. Since then, what we've created is a bear flag situation. Now, I want to be crystal clear, and I talked about this with Michelle ahead of time, is that I have not sold 1 ounce of my physical gold or silver. But on a swing trade basis, does gold in the near term say it's going lower? Yes, it does. Not only is this pattern bearish, but then we broke here. This is another bear flag, and you can see us starting to roll over. So short term, I'm looking over the next month or so, we should reattack the 44 to 4,300 level. And I know people aren't going to want to hear this, but I think in fear and panic, we are going to see a move down here to $3,500 per ounce by year end. Now, at that point, I'm buying more physical. I'm not buying physical till then. I've got enough. If it gets down to 3,500, I will buy physical gold at that point. Yeah, so this is where it starts to be understood that the run up in gold was a classic diversify against fiat currencies money until we got in that last move up. That's when emotional investors played the FOMO game. They just ran in because it was the easy trade. We saw this with silver. Those buyers that bought for the wrong reasons, the get rich quick reasons, they need to be washed out. And as fear envelops the whole system, just like it did with COVID, when we saw COVID, remember, COVID hit March 2020. we saw gold actually dump out. That's what's going to happen here on gold. You're going to see a flush out of the weak hands. It's going to dump out to about 3,500. Then it goes back to a safe haven trade and an offset for fiat currencies. And I think you start climbing back to all-time highs within another year or two. And what everything you're saying is dead on, and I agree with it. That's your macro view, right? And that's my macro view as well. That's why I still hold my physical metals. So if you ask me in 5 years, is gold higher than it is now? Absolutely. It's at all-time highs, maybe even $10,000 an ounce. But the idea here is that what we see investors in terms of their behavior is that if the stock market dumps, they panic, they get margin calls, they dump gold, right? You can see that all across past history. And that's what we're looking at here is a scenario where you see more of a deleveraging event that involves gold and silver being caught up in it. That ultimately takes it down in the short term, meaning by year end. Then it starts to regain the whole bigger trade narrative, which you mentioned beautifully, that I totally agree in. So again, it's the difference here between looking at the long term or the very short term, which to me is the next 7 or 8 months, right?
Okay, so you're saying in your scenario where there's a sell-off, everything goes down, including gold, because people have to liquidate positions. Is that
Yes.
your argument?
Yes, fear is the most pervasive trigger for everything,
But is it
and
fair?
once you
We
see that
essentially,
spike, you will see that gold sell off. And again, just drawing back to the same thing, because you mentioned all the central bank buying, I agree with all of that, but again, in the short term, fear again will rule the day and essentially create a selling and ultimate buying opportunity in gold after the dust settles, right? And so again, I would just harken back to past periods where we saw gold going up and then something occurs in the bigger macro picture in the economy, like just like we saw during the COVID period of the 2020. But you can go back in history and look, when you see panic actually hit, the initial response is sell everything, ask questions later. And then once people start asking questions, they start to say, okay, wait, now let me see. I won't buy stocks, but let me at least get my money back in gold. And I think that's what's going to happen here. And for those of us like me that love gold long term, like you, it's going to be a fantastic buying opportunity.
Silver appears to be experiencing a similar technical pattern. The metal recently declined to around $81.34 per ounce after falling more than 4% on March 15, 2026, leaving it approximately 30% below its January peak of $121. Analysts note that silver's consolidation could continue in the months ahead, with the possibility of a retest near $50. From a technical standpoint, revisiting such levels would align with historical resistance zones formed during the peaks of 1980 and 2011. Beyond short-term volatility, structural forces continue to support the broader thesis for precious metals. Persistent government deficits, rising sovereign debt, and concerns about currency debasement are prompting many central banks to diversify reserves away from the US dollar. At the same time, silver's industrial demand, from electronics to renewable energy systems, continues to expand, while much of the metal is produced as a byproduct of other mining operations, limiting supply responsiveness. In this context, temporary declines may be viewed by long-term investors not as signals of weakness but as opportunities to accumulate physical metal at more favorable levels. Gareth Soloway notes that while tactical traders may adjust positions based on short-term patterns, he continues to hold his physical holdings as a long-term hedge against monetary instability. Let's get back to the video.
I think gold within 2 to 3 years is north of 7,500, likely within 5 years to 10K. And again, the same reasons that you stated, I 100% agree with on those in terms of the debasement situation, de-dollarization, central banks continuing to try to diversify away from US dollars. There just has to be this flush out, or likely will be this flush out first. Get rid of the weak hands, let the emotion get out of the gold market, and then let it start a healthy climb to the upside like it was before this last surge up.
I mean, look, you could also argue that if this war against Iran goes well, that creates new faith in the dollar. And not necessarily in a positive sense of faith, but fear-induced faith that if the United States does again reassert its global superpower status, shows why it got the global reserve currency status in the first place, starts to control the flow of oil and makes sure that oil is priced in dollars, because oil has started to be priced in other currencies used to be that up until 2018, 95% of the world's oil was paid for in dollars. Last year, 20% of oil sales were done in non-dollars. If this war works out well, as the Trump administration would like it to, you could say that the Trump administration manages to reassert the petrodollar system, reassert some kind of dollar dominance, and that would be a negative for gold, at least in the short run.
Yeah, so based on the charts, and especially if gold is going to 3,500, silver should still pull back to about $50 a barrel. If we take a look at my silver chart here, we can see that, again, we're now stuck in what we would refer to as a bear flag formation. Bear flags where you have a big drawdown, and then you go sideways like this, and that generally results in a down move. And you can see it right here, sideways chop. And then ultimately, we're even starting now to roll over. So while I don't think by the end, I mean, literally in 2 weeks, we'd have to be at 50. So I don't think that's going to happen within my stated time frame. The last time we talked, I do think it does happen this year. I will stick to my $50 call on silver. And again, it's not going to be a popular statement, but same thing here. This is really what you look for, the retrace here. If we go to the zoomed out chart, we get down to about $50. We retest the 1980 high and the 2011 high. And in technical analysis, I'll just show this real quick lesson on TA, is that when you have a chart that comes up, you break down, you go up, you break down, and you finally break out, there's a tendency for price to want to go retest that line before it makes its next big move up. And that's essentially what we would expect to see here in silver. And so again, what's going to be the trigger? Deleveraging, my guess, kind of the same thing as we've talked about with gold, is that you'll see that pullback. And of course, you'll see the comments, this time is different, the supply, the paper supply versus physical. I get all that. And that makes sense to me in the long term, but it doesn't change the near-term drawdown scenario where you see a liquidity flush out, a margin flush out, and we see a pullback to $50. So I'm going to stick with that. Just again, maybe give me another quarter on that one.
On silver.
Yeah, I think it's going well above $120. And again, just like you mentioned, great factors on gold, the longer term. Same thing. The applications of silver. Silver again is a major byproduct of iron and lead mining, right? And ultimately, what we're seeing here is that no one's really mining silver per se to mine silver, at least not right now. It's just that byproduct. And I think ultimately that's one of the best bull cases for silver over the long term, is that, again, that's going to draw out less and less supply with the industrial demand for the industrial complex, essentially missiles, et cetera. And that's going to drive it much, much higher down the line. So I would think $200, if gold hits, let's say 7,500, I would think you're at $200 to $250 on silver within 2 to 3 years. And in all fairness, in silver, when it dumped out from 120 back into 70, I did go long on that scenario for the bounce, and then I got out right away. So I want to be clear on that. But the best thing for us here is to understand that I still hold every ounce of physical gold and silver that I bought over the last 10, 15 years, and I don't plan on selling those anytime soon. I'm going to hold those basically as an insurance policy for the continued debasement of the U.S. currency and fiat currencies overall. Yeah, it's such a hard thing to know if it's going to be, equal to. Now, again, if you ask me in the next 10 years, will we face something equal? I would say even worse within the next 10 years. But again, whether or not this is the straw that breaks the camel's back is hard to know. Now, what we do know is that you're right about rates, right? If we look at my chart here on the 10-year yield, the 10-year yield has spiked dramatically just since oil prices went up. Now, there's two folds here. Number one is that this is telling us inflation expectations are going up, aka rates have to go up in response to inflation, right? Number two, if you look at the 30-year yield, the 30-year yield is spiking to near 52-week highs because the U.S. deficit is exploding so quickly now that people that are buying the U.S. debt are saying we need a higher interest rate to take these treasuries on at a 30-year pace, right? And so, again, all of this is kind of pointing to a system that you could arguably say is it a worse situation than 08 or 09, right? I mean, where was the U.S. debt back then? It was a lot lower, right? Where was the U.S. consumer in 07? They were doing a lot better versus where we are today, right? We're in a situation where auto loans are at highs for defaults. Credit cards are at the highs for defaults. A lot of this is way different in terms of worse than things were in 07. And so Part of me almost wants to say this could be even worse than the financial crisis if it ticks over that cliff. And that's the big thing. Can the Fed pull the rabbit out of the hat? Can they suddenly come in with massive liquidity to backstop this situation? If they do, okay, they postpone it. They don't cancel it. There's no getting out of the way of this train wreck.
In such situations, technical analysts often expect a period of correction that removes excess leverage and restores healthier price dynamics. Looking further ahead, analysts see the possibility of gold advancing well beyond current levels once the broader economic environment stabilizes and investors refocus on inflation and currency depreciation. Some projections envision gold moving towards $7,500 within several years and potentially approaching $10,000 over a longer horizon. Under similar conditions, silver could experience an even more dramatic move, potentially reaching $200 to $250 as the gold-to-silver ratio compresses. The path to those levels, however, may not be smooth. Financial markets often undergo periods of intense deleveraging, during which even fundamentally strong assets decline temporarily. Should such a phase emerge, it could create the kind of widespread fear that historically marks the transition from speculative enthusiasm to a more sustainable long-term advance. If gold were to experience a temporary decline toward $3,500 while silver retests major historical resistance levels, would investors view the move as the end of the precious metals rally or as the beginning of its most powerful phase yet? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.